Welcome to Richard Suttmeier's 4 and 4. 4 blips on my radar screen presented in 4 minutes or less. The U.S. capital markets became a little bit of country and a little bit of rock and roll as Main Street deals with weakening housing and Wall Street suffers from mortgage securities that just can't be marked to market. We will see this morning whether or not Main Streets of our country have enough job growth to offset a Wall Street which rocked in the wake of the rate cut on Wednesday and could now be rolling over, as it's crystal clear that rate cuts are not helping financials. My first blip is looking back at my call to beware of the Ides of October. The Dow is down 525 points since the Ides of October, and for the reasons I projected. Earnings from community and regional banks disappointed, and the Fed rate cuts did not make bad loans solvent. The weekly chart for the regional bank index, BKX, which includes Citigroup, is trending below its 200-week simple moving average at 104.77. It's now trading at a 2-year low, and it's down 16.8% year-to-date. Meanwhile, the Dow is still up 8.9% year-to-date and would have to drop 2,900 points or 20% from its recent all-time high of 14,198 just to get to its 200-week simple moving average, now at 11,286. This will happen in 2008 as housing pulls the U.S. economy into a full-blown recession. My second blip is showing that the residential housing index, HGX, is now at levels not seen since October 2003, before the housing bubble inflated. HGX is down 35.2% year-to-date and is knocking on the door of a new multi-year low. The National Association of Home Builders does not see a housing bottom until the second half of 2008. I say they are overly optimistic. My third blip is showing that the consumer is feeling a house of pain. Homeowners can no longer use the equity in their home appraisals as an ATM to keep on spending. The retail holders RTH is down 3.2% year-to-date. The weekly chart profile shows the ETF just below its 200-week simple moving average at 96.44. My fourth blip is questioning whether or not this morning's employment report can turn the tide on Wall Street. Those familiar with my research know that I do not like this report as providing any valuable information. It's based on economic assumptions from the 1950s, and data gathering and processing methods have not changed in 25 years. The data is almost always revised in subsequent months. Payroll should grow by 100,000 in October, while the unemployment rate is at 4.7%. The question is whether or not a stronger weekly number is positive or negative. I think this data should be ignored, and we should just listen to 2 points made by the Federal Reserve on Wednesday. The pace of economic expansion will likely slow in the near term, partially reflecting the intensification of the housing correction. Recent increases in energy and commodity prices, among other factors, may put renewed upward pressure on inflation. As I have said since March, Goldilocks is getting wrinkles. That's today's 4 and 4. Enjoy your weekend and send your questions and comments to support@rightside.advisors.com.